What if $70,000 could change your financial future forever? It sounds like a bold claim, but $70,000 invested in VOO, which is Vanguard's S&P 500 ETF, is much more than just a number on a screen. This amount could represent a massive turning point for your wealth. In this video, we're breaking down everything you need to know about VOO, the Vanguard's S&P 500 ETF. We'll cover what an ETF is, why VOO stands above the rest, and how the drip strategy, combined with the unstoppable power of compounding, can turn disciplined investing into serious long-term wealth. We'll map out exactly what $70,000 invested in VOO looks like over time, and lay out a real math-backed roadmap to hitting over $3 million. No gimmicks, just strategy, consistency, and time. Stick around, this might be the most important financial video you watch all year. Also, please let me know your thoughts in the comments section below. Are you currently investing in VOO, or do you have another preferred ETF? Share your experience. It could be a key motivation for other community members. Thank you. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. First, let's start with something that nobody puts on a motivational poster, even though we all feel it every single day, and that is inflation. It isn't new, and it certainly isn't going away. But the real problem is that it doesn't care about your personal budget or your long-term goals. Even in 2026, with inflation hovering around 2.7%, prices are still marching upward. While 2.7% might sound harmless on paper, the real pain shows up in the places where you simply cannot avoid spending money. For instance, transportation costs have climbed over 5%, housing is up roughly 4%, and food and beverages are sitting near 4%, while medical care trends higher every single year. These are not luxury upgrades or fun vacations, but rather your basic, unavoidable, everyday expenses that keep the lights on. Around 62% of Americans say inflation directly affects how they save and spend, which means tighter budgets and harder choices for most families. When financial stress becomes a permanent roommate, the federal funds rate sitting at 3.72% only makes things worse by making mortgages and credit cards significantly more costly. Wages are growing at about 3.5% to 4% annually, but inflation eats most of that raise before it even reaches your wallet. The treadmill keeps moving faster, yet the finish line stays out of reach. Working more hours won't fix this cycle, but there is one fund that has outrun inflation for over 100 years. And that is exactly where we are going next. Let's answer the big question. What is VOO and why does it work? VOO is Vanguard's S&P 500 ETF, which is an exchange-traded fund that you can buy and sell on the market just like a regular stock. You can think of it as a basket packed with hundreds of different investments, all bundled into one convenient package for you. Because VOO tracks the S&P 500, it follows the 500 largest publicly traded companies in the United States, representing roughly 80% of the entire US stock market. When you invest in VOO, you are essentially betting on the long-term success of the American economy, and historically, that has been a very smart move. One of the biggest risks in the investing world is putting too much faith in one single company or one specific sector. VOO eliminates that problem by spreading your money across 500 different companies in technology, financials, healthcare, and communications. If one sector stumbles, the others carry the weight, so your entire portfolio doesn't come crashing down. The top holdings are Microsoft, Nvidia, Apple, Amazon, and Meta, which means one single purchase gives you a slice of the most dominant companies on the planet. The performance numbers are hard to ignore because the S&P 500 has delivered average annual returns of just over 10% since 1957. VOO launched in September of 2010 and has actually outpaced that benchmark by by delivering annualized returns of 14.2% since its inception. Over the last 10 years, the fund has returned 12.88%, and over the last 5 years, that number jumped to 15.9%. This is living proof that time in the market will always beat trying to time the market. VOO really separates itself from the competition when you look at the expense ratio, which is a tiny 0.03%. For every $10,000 you invest, you only pay $3 per year in fees, which is literally less than the price of a cup of coffee. Actively managed funds often charge 20 to 30 times more than that, yet most of them still fail to beat the basic index. VOO lets you keep more of what you earn, and over decades of compounding, that small difference in fees becomes an enormous amount of money. Even Warren Buffett has recommended S&P 500 index funds for most people, and if it is good enough for the best investor alive, it is worth a serious look. In addition, it's important to note that because VOO holds 500 different companies, and many of those are massive businesses generating tons of cash, a slice of those profits get sent directly to your account as dividends. Right now, the dividend yield for VOO is sitting at about 1.26%, although it usually bounces between 1.2 and 1.5% throughout the year. These payments hit your account every single quarter, 4 times a year, and they show up whether the market is having a great month or a terrible one. Now, before you roll your eyes at a 1.2 to 1.5% yield, I need you to know there is more to what you can do with this dividend yield than cashing it out quarterly. And this matters because many potential investors would look at that 1.26% yield and decide it isn't worth their time. But that is a massive mistake because the yield is just the starting point. The real story begins with what you decide to do with those payments once they arrive in your account. This is where we need to talk about DRIP, which stands for Dividend Reinvestment Plan. It is one of the most powerful investment tools, and yet one of the most underutilized. Here's how it works. Instead of receiving your quarterly dividend as cash, money which would probably disappear into everyday expenses, you set it to automatically reinvest back into more VOO shares. Those new shares then generate their own dividends. Those dividends will buy even more shares, and that loop never stops. It runs completely on autopilot, 24 hours a day, without you lifting a finger. Picture it this way. You buy your shares. Every quarter, VOO pays you a dividend. That dividend goes straight back in, growing your total share count. A larger share count means a larger next dividend. A larger dividend buys even more shares. This means that even though you haven't added a single dollar of new money, yet your investment keeps expanding and accelerating entirely on its own. That's not investing, that's a money machine. The results over a long timeline are almost always bigger than people expect. And that's precisely why DRIP is the secret weapon separating investors who just do well from investors who build real, generational wealth. It's not flashy, it doesn't make headlines, but compounding quietly does what no salary raise, side hustle, or savings account ever could. It makes your money multiply itself over and over again, while you simply stay the course. Based on this strategy, when you look at the price return of VOO over 10 years and compare it to the total return, which includes all reinvested dividends, the gap between them is huge. We aren't talking about a small rounding error here. We are talking about a real, measurable difference in how much money you end up with. The longer you stay invested, the wider that gap becomes. So while 10 years shows a noticeable difference, 30 years produces a number that most people would have to double check twice before they believe it is real. Now you can see how both engines work together to build your wealth. You have the price growth pushing the value of your shares higher, and you have reinvested dividends quietly stacking more shares on top of that growth every quarter. These two forces run together automatically for as long as you hold the fund. But seeing the actual math on a $70,000 investment is where things get really interesting. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Let's actually run the numbers on a $70,000 lump sum investment into VOO with no extra contributions, and just let time do the heavy lifting. We'll model 3 scenarios: a conservative 10% annual return, a base case of 12.88% based on VOO's 10-year average, and an optimistic 14.2% based on returns since inception. At 10 years, here's where you land. At 10%, your $70,000 grows to approximately $181,000. At 12.88%, you're sitting at roughly $235,000. At 14.2%, you're closer to $268,000. Those are strong results on their own, but 10 years is just the warm-up act. Now push it to 20 years, and the compounding effect starts to show its full weight. At 10%, your $70,000 becomes approximately $471,000. At 12.88%, that same starting amount reaches roughly $788,000. At 14.2%, you're approaching $1,025,000. That's $1 million from a single lump sum investment, with 0 additional contributions, purely because you gave it time. Now go to 30 years, and this is where the tipping point framing from the beginning of this video pays off. At a conservative 10%, your $70,000 grows to approximately $1.22 million. At the base case of 12.88%, it reaches roughly $2.64 million. At 14.2%, you're looking at just over $3.97 million. Almost $4 million from a single $70,000 investment, and all you had to do was leave it alone. Most people associate numbers like that with lottery tickets or inheritance, but this is just math, the same math that has played out, quietly and consistently, for over a century. Now, adding the drip layer on top of that will completely take your portfolio to another level. As we covered, reinvested dividends continuously buy additional shares, and those shares compound right alongside the price growth. The total return figure over 30 years isn't just slightly better than the price return alone, it's meaningfully wider. The gap between price only and total return widens every single year the fund keeps paying and you keep reinvesting. That's the real reason long-term investors treat DRIP as non-negotiable. For perspective on why the decision to invest in VOO completely outplays regular savings, consider this. If you leave $70,000 in a savings account earning 2% annually over 30 years, it will only grow to about $127,000. That's it. Inflation running at even a modest 2.7% over that same period means your purchasing power has actually shrunk in real terms. You didn't just miss out on growth, you fell behind. Remember that based on our demonstration, investing $70,000 in VOO at the base case returns produces $2.64 million, while leaving $70,000 in a savings account for the same time period will produce $127,000. That's not a small difference in strategy. That's a completely different financial life. The math is clear, but there's one thing that can kill this entire plan before it ever gets started, and it's not the market. And guess what? It's not the ETF either. It's deciding to stop due to any minor turbulence in the market. Most people bail out when the market drops 20% and the headlines turn ugly, or they let the numbers feel too big and decide to wait for some perfect moment to jump back in. That right time never actually comes because the market doesn't send out invitations when it's ready to go back up. If you look at every major crash over the last 100 years, from the Great Depression and the dot-com collapse to the 2008 financial crisis and the 2020 pandemic sell-off, the market recovered from every single one of them. The investors who stayed in and refused to let fear override the math were the ones who captured the full return on the other side. $70,000 isn't the finish line. It's the moment everything changes. It's the ignition point where your money stops sitting on the sidelines and starts working overtime, compounding relentlessly year after year, building wealth in the background while you sleep and live your life. No complicated strategies, no insider secrets, no Wall Street connections required. Just a proven, simple, and powerful formula that rewards patience and consistency above everything else. The investors who build real wealth aren't necessarily the smartest in the room. They're the ones who start, stay the course, and let time do the heavy lifting. Turning $70,000 into $3 million isn't a fantasy, it's a math equation. And now you have the blueprint. Please let me know your thoughts in the comment section below. Are you currently investing in VOO, or do you have another preferred ETF? Share your experience. It could be a key motivation for other community members. Thank you. Now, if you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Listen, if you want to know the 5 best Fidelity index funds to buy and hold for life, or the 5 best high-yield ETFs for monthly dividends with zero NAV erosion, check out the videos on your screen right now. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Thank you, my friend.